In August 2021, Jordon Peterson and four young Bitcoin enthusiasts, in adherence to the Austrian School of Economics, made a video to explore and propound their economic views. While we share some of their positions, we think that there are serious flaws with their thinking. Our view constitutes a very different perspective. So who are we? My name is Oliver Haydorn. I am a PhD in philosophy. I've taught philosophy in a number of different countries at 3 different institutions. In the last few years, I have been doing a lot of research in the area of Douglas social credit, which is not to be confused with the Chinese CCP counterfeit social credit. I've published a number of books in this field of Douglas social credit, the largest one being a 500-page tome on the economics of Douglas social credit entitled Social Credit Economics. And my website is socred.org, SOCRED.org.
My name is Charles Pinwell. I'm the Australian part of the twosome, Oliver being Canadian. And my background is in farming. My parents were farmers, my grandparents were farmers, and their parents before them. I think I came to an interest in politics, which is 50 years old now, largely through my belief that in subsidiarity, that big word means that responsibility and decision-making should happen at the lowest level possible in society. And I had an attitude that centralising power away from the individual, away from the lower group when it's unnecessary and when they're capable of handling it, was a form of evil and disenfranchises them. So that got me into politics and to looking at money and money systems, because money systems have the ability to disempower the individual. There's no doubt about that. I'm a published author at this stage. I've recently published my book, Different Essays, in brackets, they're certainly different. It's 500 plus pages and 100 different essays. Probably the majority of them appertain to economics. So we're going to discuss Jordon Peterson's video and comment on it. And Jordon Peterson's video begins like this.
Well, hello everybody. I'm trying something a little different today. I'm speaking with a book club set up by John Velas, essentially centering on Bitcoin, which is a phenomenon that I'm very interested in but know very little about. I ran across John's podcast partly because their book club also focused on my first book, Maps of Meaning. And so I looked up Gigi Durr, who's speaking with me today, John Velas, Richard James, and Robert Breedlove, who make up the 4 people in this particular incarnation of John's book club.
Before we get into Jordon's video properly, we thought it best to provide you with an outline of our alternative proposals. We believe that the reform and the reorganization of the existing monetary system, which is a fiat currency system plus bank credit, with bank credit making up the bulk of the money supply, is essential, right? Reform is essential. The Austrian school, from what we gather, doesn't believe that any reform is possible. They think the system itself is irremediably broken. We would also say that the type of money system that we have, this fiat currency system plus bank credit, is the one that has been adopted because a commodity-based monetary system isn't really feasible. It's too inflexible. So there was not really an alternative to the system that we're using. However, there are a number of different ways in which a fiat currency system and its attendant bank credit can be organized. And some ways are better than others. And we believe that there is an optimal way of organizing it. And it's for that optimal reform or reformulation of the existing system that we think is the solution to the financial problem?
The Austrian school seems to believe that, gold has great qualities of money system. We don't. We think it has serious problems. And the world tried very hard to keep the gold standard, and we'll talk more about that later. The Depression, for instance, which began in 1929, was still raging in 1941, where 20% unemployment was the situation in the United States. And as John Kenneth Galbraith has said, it wasn't really the end of the Depression was not brought about by Keynes. It was brought about by a fellow called Hitler, who went to war, and they had to increase the money supply in order to finance the war. What we're proposing is the democratization of money, if you like. Yes, a fiat money, because it's easy to create, and it's easy to create ballot papers too, but we all get an equal share, and that's a system that works. We're saying that when there is a need to create money, there has to be a proper basis for working out how much, and we'll talk about that later. But the new money creations should be shared by all the shareholders in the country, all the stakeholders, and that's we the people. So we're proposing to do a national set of accounts, which will discover the relative effective demand and purchasing power as against the consumer goods and services available. And on that basis, fiat money, yes, would be created. It would be distributed as a dividend. And the calculation of how much of that would be done with a national balance sheet and a national profit and loss account. Those prototype accounts have already been done. The first national profit and loss account ever done on Earth was done for the United States for the year 2014. It discovered that the total income of all Americans aggregated together was $10.1 trillion, and the total amount of consumer goods that were actually produced and sold was $12.5 trillion. They bought $2.4 trillion more product than they had incomes to do it. And that was done by creating fiat money as a debt. So debt was used instead of a national dividend to keep the economy operating.
So we talk about a deficiency of consumer purchasing power, and that is caused by what we call the gap in Douglas social credit theory. The idea being that we have costs and prices that are being built up in the course of production, and at the same time we have incomes that are being distributed to consumers in the course of production. But we claim that the rate at which costs and prices are being built up exceeds the rate at which incomes are simultaneously being distributed. So this causes an underlying gap or a deficiency of consumer purchasing power in the economy that the economy has to try to compensate for in one form or another. There are many reasons, many causes behind this gap between prices and incomes. The main cause, we believe, has to do with the nature of capital costs, that when you look at machinery, equipment, real capital, the costs associated with manufacturing these things or purchasing these things, the costs associated with replacing them, depreciation, the costs associated with maintaining them, means that companies have to demand more money from the consuming public than they are simultaneously putting in the pockets of the consuming public in the form of wages, salaries, and dividends. So there's this fundamental imbalance in economic life, given the rules of finance as they currently operate. Now, we maintain that this deficiency can be measured. And it can be filled by monetizing the gap with credit, which would then be distributed to people in the form of, let's say, a national dividend. And the national dividend, as Chas was mentioning, this is an amount of money that would be distributed in equal proportions to each citizen considered as a shareholder in his country. It would be given independent of employment status or, independently of work.
And well, part of the reason I wanted to talk to you guys was because when I started looking into what you were doing, I was struck by two things: that there seemed to be a psychological element to your endeavor, but also perhaps to Bitcoin and the Bitcoin community, such as it is. And then also, I was interested in your philosophical speculations about the domain of value. And so we'll delve into that. What have you noticed about individual transformation? And do you think it's particular to Bitcoin? And it's a strange thing to notice and to bring up. So maybe you could elaborate on that a little bit.
Sure. Well, the answer is yes. And one of the interesting overlaps between your work and you and the changes that are represented in people that get involved in Bitcoin is I think there's a lot of the instantiation of a lot of the things you talk about are represented in the changes we're seeing in people that engage with Bitcoin. And of course, notwithstanding that your work generally, as it permeates out into the culture, is providing people with ideas to chew on, and that causes some degree of change. But what I've noticed in people in Bitcoin is that it rapidly accelerates this change toward taking more responsibility, as it were.
They make the point here that Bitcoin changes people towards accepting more responsibility. And I don't doubt that it does. But all property does that. If you buy your first home, you tend to be responsible for it and want to care for it. It's the same with buying a motor car for a young bloke. Perhaps the most dramatic thing for an Australian historically is that we received England's criminal class, or so-called, from about 1788 for the next 50 years. And towards the end of that 50 years, there was a survey done through the courts, and it was discovered a remarkable thing, that the sons and daughters of that criminal class were 5 times less likely to commit a crime than the free settlers were. And that is because they'd come here, they'd got away from malnutrition, they got some vitamin D from the sunshine, they had a nice free environment, land was relatively easy to select, and they didn't want to go back to that other world. So yes, property is terribly important, and it does encourage responsibility, and all property does that. I don't think it's particularly attributable to Bitcoin.
So in terms of our alternative proposals, I just wanted to add that we are completely in favor of the principle of private property. We think that private property should be more equitably and distributed and more widespread. And we're completely in favor of the augmentation and personal responsibility that comes with private property ownership. So, we're not in any way supporting any kind of socialism or communism or anything like that. We want to make private property more secure rather than less secure.
Bitcoin represents the information, let's say the truthful speech, that rectifies pathological hierarchies that evolved as a result of false money, as a result of fiat money, let's say. And I think you could broadly say that money is information regarding your own value hierarchy.
One of the key strengths of capitalism is that it furnishes information about costs and it ensures efficiency. With costs measuring inputs into production, if $50 worth of value is contributed to producing an article, but it can't be sold for more than $20, then obviously that's an inefficiency and it won't be reproduced. In a centrally controlled economy, of course, if the government says this will be produced, it is, and it disregards proper checks and balances and attention to efficiency in that way. Money measures that, all money does that, and that's one of the great strengths of the capitalist system and has to be retained.
We completely agree, of course, that there have been pathological hierarchies that have developed on the basis of false money. So, there's commonality between what this fellow is saying and our position. We agree in broad terms on the diagnosis that money is not an honest system. It's a false system. But why and how it's false and what should be done to make it an honest system is where we would then have some differences.
I've become interested in Austrian economics and going to be discussing Austrian economics with some Austrian economists. Well, they're not actually Austrian, but they're from that school. You also have a profound sense of sartorial splendor, just so that you know it.
So the Austrian school says that fiat money, which is money that is costlessly created, is a problem, and that therefore the answer to that problem is to have expensive money, scarce money, difficult to create money. But we can ask ourselves, if we look at the voting system, why don't the electoral officers create more ballot papers, votes, than they do, right? They have to be distributed on a one-to-one basis, and they can't keep extra votes for themselves. So there's something about the voting system which limits the number of ballot papers that can be created. Why can't the banking system, the money system, work on the same basis? If the banking system had to respect certain physical parameters, if the gap was measured and we distributed that gap to everyone in the form of a national dividend, then we wouldn't have a basis for creating more money than that or less money than that. We'd just have enough to ensure that what is created can be distributed in full. The problem, of course, with a fixed money system where you've got static or near static volumes is that it would render the economy inoperable. Right? And yeah, we don't think that sort of system is going to be feasible or workable in the end. And if we can sort of change the existing system so that the beneficiaries of a fiat currency plus bank credit, the beneficiaries of that system are not a small oligarchic group of plutocrats, but rather the shareholders in the economy, the citizens, then we should be able to overcome some of the concerns which the Austrian school has with the existing fiat currency central banking model.
I also came across the Austrian School of Economics, and I found that to be particularly eye-opening, and it led me down this path of asking that question of what is money. And as we've already mentioned, gold plays such an important role in that, and I think that understanding gold is the first step to understanding Bitcoin. And so in the last couple of years, I've sort of turned back to filmmaking and trying to link that interest to Austrian economics and Bitcoin. And last year, I sort of set myself a goal for a project to make a film related to Bitcoin, and it had two particular parameters. One was that I wasn't allowed to spend $1, and it had to cost $0, and the other thing was I wasn't allowed to leave my desk. So I sort of basically put this thing together using content that had already been created by people working in Bitcoin and talking about Bitcoin, and the film's called Hard Money. It's available free online. So that's sort of been my contribution, I suppose. But I'm more interested in the philosophy of money.
The first thing perhaps we need to address is maybe a question of inflation. An example I think that might be useful. Suppose we had a small community that had built themselves a theatre and they were putting on a play, and they induced people to put on the play and do the stage backgrounds and make the costumes and all the other things by paying them in tickets to attend the play. When the night came for the play to happen. 100 seats in the theatre. They've paid out 60 tickets to those that have contributed to producing it. Now, what do you do with the 40 vacant seats? Is creating 40 extra seats and handing them out in some way to the community in which the community agrees, is that okay? Or do we have to have somebody who, an official ticket manufacturer, who has the right to insist that all those tickets have to be paid back at some other date bearing interest? So there's an ethical framework, of course, always called into play with money systems. We're all interdependent to some extent, and everybody contributes something into the community. And therefore, there's no basis for the monetisers of credit to steal it all. Additional fiat money belongs morally to everybody in part. There'll still have to be money being invested in production, but any money created for the purpose of augmenting consumption should, we suggest, be distributed equally, and everybody should share in it.
We see this question again, what is money? And we might mention that as far as Douglas social credit theory is concerned, we use a definition of money that goes back to a certain Professor Walker. And he said that money is anything, no matter of what it is made, no matter of what material it is made, that no one will refuse in exchange for his goods. So it's a definition of money based on its function. Anything that serves the purpose of money is money. And we don't have to sort of be obsessed about whether it's made of gold or some other, rare commodity.
And libertarianism and these ideas that there's a certain way of thinking in Austrian economics called praxeology, which is about human action and the way that really analysing the way that people sort of pursue. It's very general in the way that they use means to pursue ends. Like that's the very first kind of axiom of the system, and from that we can draw a whole lot of deductions. And it's interesting the way that leads you down an ethical, being able to create an ethical framework as well. And that's where I guess your own work came into it, where, I found myself interested in this libertarian system of ethics or morals, and, Maps of Meaning, I think is essentially a book about morality as well, in that it's a book about how to act. So I found some very interesting parallels there.
And what was it about? How would you define the Austrian School of Economics, and why was it of particular interest to you?
Well, the Austrian school is, I would say, it's a way of thinking that is about logical deduction rather than empiricism. I think the problem with economics in its current form, modern economics, Keynesian economics, because it's largely influenced by the work of John Maynard Keynes. I think it has a problem where it has this desire to imitate a physical science. It wants to analyze data, get complex in a mathematical sense. But there's a fundamental problem there in that when you're trying to analyze something in economics, we can't set up an experiment and, run a test on a parallel universe. We're dealing with real world. You can't isolate the independent variables, basically. So it makes that kind of analysis fraught with a lot of danger. Whereas the
behavioral economists are trying to deal with that to some degree, right? By running actual economic experiments. They're more like psychologists. They are psychologists fundamentally.
And the Austrian school takes a very different approach, which is to say, we'll take a certain set of fundamental axioms, and then we'll build our philosophy based on logical deduction. So it's sort of all done from the armchair, basically, rather than trying to validate anything via real world data.
So from a philosophical perspective, a purely philosophical perspective, I wanted to point out that, in my opinion, I think that the Austrian school has got it all wrong methodologically, because if we try to spin out a theory based on logical deductions from premises or axioms, the system that you're going to end up with is only as good as the premises. If the premises that you're working with are false, and the system that you will then have, as logically and consistent or as logically coherent as it might be, is not going to be correct, and therefore won't in any way be useful, because the only way of ensuring that a theory corresponds to reality is to check it against the real world data, that is given in experience. So in order to have any economic theory that has truth value, we have to be able to base it on the things themselves. We have to be able to base it on what's given in experience, which need not be limited to sense experience. There are other forms of experience, but fundamentally we have to be able to show that this elaborate theory that we're developing has some bearing on what actually goes on in the real world. And it seems that the Austrian school is, by throwing experience overboard and trying to do everything from the armchair via deduction, is basically cutting itself off from the real world. And so why would we have any confidence in anything it has to say?
I think there's a problem with overemphasis on abstractionism. If we're not going to relate the money system to hard data, we're in big trouble. If we're not going to measure the amount of purchasing power against the amount of consumer product that's there, we don't know what to do about money. We could do what they did in the Depression, increase the money supply right throughout the Depression, but increased it so slowly that we had a continuing depression. So you need to measure the thing, and it doesn't make any sense to say that you can move away from objective measurement. Honestly, you can't. No company directors would try to run a company without doing balance sheets and profit and loss accounts, but no governments do these accounts. They just don't do them. They're the only entities on earth that don't do comprehensive balance sheets and don't do proper profit and loss accounts from the point of view of their shareholders. So we're in trouble if we're going to try to base it on some theory or some historical sort of thing of value like gold, which we'll say more about later.
I guess the relationship between action and economics and value, I suppose, is that people choose to act in relationship to those things that they value, and that the manner in which they act is actually an indication of what they value. And so money becomes an index of people's value preferences, and value preferences associated with their preferences for action. I mean, that shapes even such things as perception, right? Because perception, we think about that as something that's automatic, essentially, because the world just appears to us in some sense. But you move your eyes constantly and you orient your head so that you can hear one thing rather than another, and you pay preferential attention to one thing rather than another. And you do all of that as a consequence of comparative value. And I was reading a book on Austrian economics last night, and they were talking about trying to define economics. And it struck me that the most suitable definition was something like the science of comparative value.
Well, Jordon, as always, is wonderful on comparative values and perceptions and action and value. And we all admire him for what he's contributed in those areas. For myself, I think economics was correctly named at the beginning when it was when the Greek words were chosen, which mean housekeeping. That's what it's really about for 99.9% of people, really. They're about production of consumer goods ultimately, yes, capital goods, but only as a means to produce consumer goods, and then the use and distribution of those household goods. That's what economics is, and that's all good. And trying to abstractionize the thing, if there's such a word, gets a bit out of hand.
And my realization is that the world is so poorly informed about the socioeconomic significance and even philosophic significance of Bitcoin that it was incumbent upon me to take what I think I see as the solution to many problems in the world and just pour all my energy into education.
Well, I think when philosophizing about money, the point might be made that if a national dividend was used to distribute every increase in the money supply, and it is a man-made thing, so it's all created from nothing really, and that was distributed to everybody on an equitable basis, this would have a very profound philosophical impact on society. It would free it up in many ways from many pressures, and hopefully it wouldn't be as grasping. Scarcity wouldn't be so much feared, and we'd probably have more time for each other.
Robert Breedlove says something quite interesting here about why he took an interest in Bitcoin and wanted to spread awareness of both it and Austrian economics. And I wanted to point out that both you and I, Chas, went into Douglas Social Credit and have tried to spread knowledge out for the same reason. Namely, we see in it the solution to many of the world's problems, because when money and the money system are not designed properly and do not function properly in consequence, it affects so many other things. So many other problems, directly or indirectly, have a financial component. So if finance is out of kilter, then it's just going to make it more difficult to deal with other social, economic, political, cultural issues. So it's quite important that we figure out collectively what needs to be done with money to fix it, to make it an honest system, so that everything else upon which society is based can function on a secure foundation.
Because I do believe that question, what is money? This is the gateway to this rabbit hole that we've all fallen down. It is the key to unlocking a lot of the untruths in the world. And I think it's also the key to perceiving the corruption that's embedded in our current socioeconomic system, at the core of which is central banking, which I'm sure we'll get into a lot today. And yeah, I would just, to echo a couple of the things that were mentioned earlier, that question, what is money, has a lot of answers. One of which, as I think you've related in the past, is that money is essentially a contract with the future. And today, fiat currency, it's a violated social contract. So we have a money by which an institution effectively robs our future. They're compelling the demand for this money, and they're violating its supply to enrich themselves and dispossessing everyone else, mostly people economically vulnerable. And to the point about morality, it's like, if we don't have a secure social contract in the most important market in the world, which is money, then we can't possibly have a foundation for a sound social morality.
So we also agree fundamentally that the present financial system is accurately described as a violated social contract, and that as such, it doesn't provide any firm foundation for social morality. And the reason for that is simple, because it's not an honest system. We say, why is it not an honest system? It's not an honest system because it's not properly designed to provide us with an accurate reflection of our real wealth on the one hand, or our capacity to produce real wealth on the other. And that's what we aim to fix with the sort of reforms that we would introduce into the system.
Why do you think the fiat currency versus Bitcoin issue is relevant to that conundrum?
We could say it in the very severe original state of nature, where we're all just cavemen running around trying to eat and have shelter. That is an environment with a lot of scarcity, right? There's a lot of economic scarcity because we haven't begun to trade. We haven't created the division of labor and specialization that creates wealth. And I would argue that fiat currency, because it generates arbitrary inflation. So it's artificially magnifying prices in the world. It's increasing prices when prices should be declining as we get smarter. It's actually magnifying the perception of scarcity in the world. And I think that contributes to social divisiveness, up to and including things like cancel culture and other things we see in the world today. I really believe that artificial central bank induced inflation is a corrosive moral cancer on society.
I think the Austrian school, when it moralizes about money and believes it's morally, that Bitcoin is morally regenerative, the basis on which they do that is that the present money system is corrupt. We can agree with that. But the Austrian system doesn't offer any reform to the current money system, and it will be, and always will be, and always has been, a fiat system, really. We'll discuss that a bit later too. The Austrian school doesn't suggest anything to actually correct the current fiat system, except to go back to some scarce money that's difficult to create, as though that's the solution to the whole thing. However, part of what they say is that it's something that's generated independently of government and independently of central banks, which is true enough for the moment. But that difficulty is going to be overcome whenever government chooses to do so. There will be disputes between cryptocurrency traders. Some will pay and not receive the product. Some will receive the product and not pay. So disputes will arise. How will we settle disputes of that nature? Well, the courts will arbitrate, and whatever government arbitrates, government regulates. So we can look forward to the cryptocurrencies when government can be bothered attending to them, regulating them and taxing them. And so some of those attractive things at the moment, like you can freely do whatever you want, they're going to disappear. And we're going to still be left with a fiat currency, which is corrupt, which does steal the real credit from the community and hands them, it gives it to them only as a debt bearing interest. And so it's not really offering a moral solution.
We also have a different explanation for the phenomenon of inflation. From our perspective, most inflation is cost push instead of demand pull. And it's basically caused by the influence of debt and the necessity of repaying debt. So when you've got debt servicing charges, this both directly and indirectly, it lowers the purchasing power of consumers. It lowers what consumer incomes can buy. And because some of the money is diverted to servicing these debts, and that causes people to demand wage and salary increases in order to maintain the standard of living. But when those wage and salary increases are granted, that will eventually filter through into an increase in prices, because businesses, of course, have to cover in costs what they need to cover for the wage and salary increases. So this creates a sort of a wage price spiral, and prices keep going up and up and up. And that is something that doesn't seem to be on their radar at all. They seem to assume that all inflation is demand pull. It should also be pointed out that merely increasing the money supply is not in and of itself inflationary. You've got to have an increase in the money supply accompanied by an increase of prices. If you increase the money supply and you spend it on additional production, you'll have more things, more goods and services to sell. And so that need not automatically result in an increase in prices. Similarly, if you increase the money supply in the way that we suggest in order to increase the flow of consumer buying power so that people can buy what's on offer without going into debt, then that also is not something that must result in an increase of prices through this phenomenon of demand inflation. Finally, we think that if you can balance the price system along the lines we suggest with a national dividend, then in that situation, we can remove the effects that all these debt burdens have on the price structure. We can actually neutralize the whole phenomenon of inflation. So fiat money, a currency system, with the attendant superstructure of bank credit, is not inherently or necessarily inflationary. It depends on the rules and the regulations according to which that money is created, distributed, paid back, and so forth.
As a technology, money needs to fulfill 5 critical properties. It needs to be divisible, durable, recognizable, portable, and scarce.
That's interesting, but one of the qualities that make gold so popular a money system is that it's useless. You see, when monies began, they began in Egypt largely using grain as the commodity money. But when a famine came along, everybody ate the money system and they didn't have one anymore. But with gold, it's so bloody useless that nobody will ever use it. They'll display it, but that's all you can do with it. It's, of all the commodities on earth, if you had to pick one that was going to be sent to the far side of the moon, be inaccessible forever, that would have the least impact on human life of any other commodity, any other mineral. We don't need a scarce money system. We need a sufficient one. We don't need it to be either in deficiency or in excess. The profit and loss account that we did for the United States, it showed the deficiency to be 2.4 trillion, which incidentally amounts to $7,500 for every American and to $30,000 for every American family of 4. That was overcome by increasing the total amount that Americans own through government and industry and as consumers and in every other way by 2.3 trillion. Now, if that hadn't been done, 20% of all the consumer goods would have stayed on the shelf and we'd have had a very severe recession. So that's what fiat money can do. And that's what it has to do if what we're saying about the gap is true. Now, how do we know whether there is a gap there? You measure it. The only way science will recognize anything is that it's measured. If a crocodile's been measured, we know that a crocodile must exist. We measure light waves, we measure all sorts of things, and that's how we understand things. So if we're going to understand economy, we have to measure it. We can't go on abstractions and vague ideas about innately precious commodities. So if money is created in the right way, that's okay, but it has to be in the right way. We need a national balance sheet, and this is very interesting. When you consider national assets and liabilities, the money supply is a liability. Assets are advantages. Liabilities are those things that make claims upon our assets. So every dollar that's in existence is a liability. And if we did a national balance sheet, even politicians would be able to see that money is a liability. So you don't create more liabilities than you need. You create enough to make the thing function. They can't see that because they don't do ordinary company books, and they never will see it until they do, I suppose. So we need to create money in the right amount. And as Oliver has just said, most inflation is cost push, not demand pull. Gold, in a sense, enshrined and glorified deflation. In the 19th century, if they'd had a gold standard, the money supply would have been contracted by 98%. There has never really been a gold standard money system. Initially, when the goldsmiths gave receipts for gold, they created another 9 and became that much richer, and they loaned those into the community, and the story goes on. But it proved when the First World War broke out and people wanted gold, the Bank of England never had more than 2% of their deposits in gold. So it was never a gold system right then, and it hadn't been for hundreds of years. In fact, when the Bank of England was founded, it was founded by a fellow called William Patterson, and when he was promoting it, he said, "The bank shall have benefit of interest upon all monies which it createth out of nothing." See, we get some people saying that what the community chooses to be money is the right money to have. Well, there's no doubt at all that society has universally, for hundreds of years, chosen fiat money, and fiat money has dominated the whole of society. What we've got to do is tame the animal, not try to substitute some lame and inadequate and inflexible and ridiculous cube of gold. And as Warren Buffett has pointed out, all the gold ever created since the beginning of the world, if you put it into one cube, what would its measurements be? It will be 20 metres by 20 metres by 20 metres. If we're going to base the whole of the money system on a cube like that, you could sit on an ordinary suburban house block, then I can't think of anything more ridiculous and outrageous and crazy and inflexible. And it wouldn't work. The reason it was not continued with is they couldn't make it work. Churchill tried to make it work. They abolished it during the First World War because they had to create heaps of money. Churchill was instrumental in bringing it back. It was a disaster. The English abolished it completely and forever in 1931, and Churchill apologised for it. You can't go back to a system which is so inflexible that everything's got to be based on a lump of metal you can stick on a house block.
And of the monetary metals, gold was the most scarce. And scarcity of money, so what scarcity means is when demand outstrips supply. But what's unique about money is that demand always exceeds supply. There's never enough. People always want more money, right? It's not like you're going to reach a certain amount of apples in your kitchen and you're satisfied with apples. There's always more demand for money. So we could say that money always has this scarcity property inherent to it.
Well, what money is effectively is demand. It's the right to demand goods and services. It's simply evidence of a claim, and it's an enumerated abstraction that makes demands upon others. And if it's insufficient, we go into depression. If it's excessive, we can have outrageous inflation, of course. What we're saying is that it has to be measured and applied in right measure. The statement was made that there's always more demand. Well, that's not true, because what matters with demand is effective demand. You can have starving people everywhere and they'll have a demand for food, but they haven't got $1 to buy a sandwich, they're going to starve to death. So we're talking really about effective demand, not about demand as such. So we're regulating effective demand to realistically our productive capacity, our ability to supply the needs of each, material needs of each other. So what we need is effective demand balanced against consumer product existent, and then we won't have inflation. We'll only have 100 seats filled in the theatre and not 150, nor will we have 40.
Yeah, so we have this idea again. It's a notion that's found really throughout economics that Robert repeats here, and that is, we always want more. We always desire more money, or we always desire more goods. And in certain situations, sure, someone might want more money or want more goods, but the reality is that there's also a limit to what you can meaningfully consume, right? You can only eat so many meals, you can only wear so many shoes. Even Imelda Marcos only had 5,000 pairs of shoes as opposed to 7,000. So it's important to keep in mind that there are definite limits to what, as far as goods and services are concerned, there are definite limits to what you can meaningfully consume. So there must also be realistic limits to what we can demand in terms of money and in terms of goods and services. Economic demand is not infinite. There might be desires in the human heart that could be described as infinite, but they don't really correspond to goods and services. And it's important to realize that there's a limit there.
The temptation to manipulate its supply has proven historically to be essentially irresistible. And banks, which tend to become central banks or nationalized banking operations over time, have always violated that trust function placed within them.
Can you give us some recent examples of that?
Well, sure. In 1971, the infamous Nixon shock, he took the world off a gold standard.
So we would say that the temptation to inflate, it wasn't that it was so much irresistible because people were seeing it as a way of profiting disproportionately, although that motive always exists. But the system is set up in such a way that we have to inflate the money supply for the simple reason that our societies are profitable. We do produce more than we can consume with the incomes that are distributed in the course of production. So in order to keep the economy working, in order to keep things going, in order to distribute what's produced and to meet the costs of what is produced, we have to increase the money supply. And under the current system, that means we have to take out more debt. That's just the way it's set up. Now, we propose that the additional money that the economy needs to function could be provided as a, if you like, debt-free credit. And that would cancel out any, debts in the price structure that had not been met by incomes made available, and it would eliminate cost-push inflation.
The point about Nixon abolishing the gold standard in 1971 is really laughable. The gold standard had been stone dead for at least 200 years, and no more. There wasn't more than 1 or 2% gold to back the US dollars. What fell over ultimately was the myth of gold. It had been a myth forever. And whenever there was a run on the gold, like there was when war broke out in England, the First World War, the gold standard was finished in 2 days. 2% of people wanted their money in gold, and it wasn't there. It was always a myth, been a myth for hundreds of years. And in 1971, it was another myth, sort of just put up there for political reasons. People wanted to feel that there was a commodity behind it. It never was. It never could be. It never worked. It never financed the Industrial Revolution or empire or developing the world with a block of metal that 20 metres each way. It's ridiculous. But because there was a tradition of saying, oh, it's as good as gold, then they tried to keep that myth there. But it's stone motherless dead now, and there's no bringing it back. And any attempt to bring it back would end, as Churchill's experiment ended, in an absolute disaster that would have to be abandoned almost as soon as it started.
Let me ask you a question about that. So maybe I could make a case that, you know, because we're all interdependent, whenever I generate wealth, I generate it as a consequence of my interdependence with other people. I wouldn't be able to do it on my own. I'm dependent on the infrastructure. I'm dependent on the government, or at least I have the advantages that those things provide me.
So if the financial system were designed as we think it should be, that is to say, as an honest system, then it would have to incorporate the fact that wealth is a product of interdependence. If we give everyone a national dividend independently of their work status, because we recognize that they are shareholders in society and heirs to the cultural heritage which made this surplus, this profit possible, then we are acknowledging in a very concrete and real way the fact that wealth is not something that is produced by a lone individual, but it is produced by individuals working together in community. And that aspect of our economic arrangements would, well, perhaps for the very first time, receive real recognition.
I could jump in here, I think. I would say unquestionably, debasement of the currency, it is an arbitrary harvesting of the economic surplus a productive free market economy is creating.
Well, we agree, of course, that inflation is an arbitrary harvesting of society's economic surpluses. It's very, very true. But we are suggesting an equitable distribution as a solution, as an actual workable, measurable, and applicable solution. And the Austrian school doesn't quite know what to say to that, except perhaps to deny that efficiency of purchasing power progressively and continuously is generated in a society with very long lead times, and we're in one in which capital is actually produced. Capital is responsible for more production than is labour. The facts are that most production now is attributable to our industrial inheritance. If you take a carpenter's tools off him and say, right, build me a house, he's got, if you'll make him go back to understanding metallurgy and digging a hole and so on to produce his first tools, it's going to be very difficult to build a house. But we've got all those things, we've got so much, and basically it's our inheritance which is shared by all of us and which our ancestors have contributed to from time out of mind. So that is the real basis of production, and it should be equitably distributed, and we quite agree that it shouldn't be harvested surplus for an elite.
Emphasize that because it's such an important point, and it could easily be skipped over, because, you know, there are people who admire the ideas of central planning, and you think, well, maybe there's 40 people doing your central planning, and so maybe they're the smartest people in the world and they're doing your central planning, but they have to calculate on the fly a virtually infinite amount of information. If they don't have free market prices at their disposal, they have to calculate what metal is worth, what nails are worth, what labor is worth, what rubber is worth, what cleanup is worth, what nursing is worth, et cetera, and they have to do all those comparisons, and they have to do those computations, and there's actually no way even technically of doing that, and the alternative is to distribute that calculation across a virtually infinite number of actors, or actors in the billions at least, and let every single person act as a computational device and sum all that. And that's what the free market does.
We quite agree that the free market is a much better system for the production of goods and services than a command system ever could be. The advantage of a free market capitalist system is that it values efficiency. So if an entrepreneur spends $50 in resources in trying to produce a particular good or service, and the free market doesn't value that, and he only manages to obtain $20 in exchange for what he's produced, then that production will cease. He'll go bankrupt. He won't, because he wasn't able to recover his costs. So that's, that's something that can't at all be denied. And what we're proposing has absolutely nothing to do with any sort of centralized control or centralized planning. We merely want to put the financial system on an honest basis so that the free market can function with the information that it requires, with accurate information and not with information that's skewed.
In fact, say that the free market is a pure economic democracy. People are voting by buying and selling.
We would add that the free market is a pure economic democracy if and only if the financial system that it uses is also honest and democratic. So this sort of ties in with what I was just saying in the previous section, that if we have a financial system that's dishonest, that's skewed, that's not giving us accurate information, that obviously is going to interfere with the capacity of the free market to function in this, according to this model of a pure economic democracy.
I might just add that economic democracy, in which the electors don't get the votes except as debt, repayable debt with a rental charge called interest, is not altogether economic democracy. The free market is, but the money system negates that in that situation.
And to tie this back to the problems with the dollar is, the dollar was gold.
Well, I'm afraid the dollar wasn't gold. Gold was the currency, was not just a myth, it was also the mantra of many, including the Austrian school, to be honest. As I've said, the whole construct of claims upon each other was built on a basis that it was supposed to be backed by gold. It never was, and it can never be. So claiming it historically is a damn nonsense. Right back at the beginning, that was known when the Bank of England was established. It was established with the point in mind of creating fiat currency. And that was before, and they financed the Industrial Revolution and they financed the British Empire. And you wouldn't do that with a few square meters of a metal symbolizing everything. It's just undoable. That was the myth and the mantra. And if we can put that aside, bury it historically, which it has to be, we've got to tie money to what it does give it value, and that is goods and services. It's not gold. If we had all the money and we could buy all the gold, we'd both die of starvation and thirst. It's goods and services that we contribute to each other. That is the wealth of the world. Gold could be sent, as I said, to the other side of the moon, and it would be meaningless to the human economy. We couldn't send molybdenum there because we need it as a trace element.
Why do we allow this? We're not going to degenerate into conspiratorial thinking, and I'm always wary of any conversation that involves they, an external actor. Like we've allowed this as a global community, and if what we've done is flawed in the manner that your analysis indicates, why have we allowed it to happen? I could say who benefits, and we could go there to begin with. But again, as I said, I'm very leery of conspiratorial thinking. I tend to think of large-scale social problems as everybody's problem, But so what do you think about that? Why have we allowed this to happen? And let's say who benefits and why.
So Jordan asks this question, why have we allowed this? Meaning, why have we permitted the burgeoning of fiat currency or a fiat currency-based system where money is always being created in ever greater quantities? And as we've mentioned before, from our point of view, it was because there was no alternative. We have this gap between prices and incomes. There's not enough consumer purchasing power automatically being created and distributed to clear the market. So we have to get more money into the system just to maintain equilibrium. And that more money comes from the creation of additional debt money through the banking system, which then is used, for production, capital production for exports, so on and so forth, or is lent to consumers in the form of consumer loans. And all of these are means of trying to get enough buying power in the economy so that we can cover costs and distribute in full whatever we produce.
You see, the problem with filling the gap with debt is that debt has to be recalled later. So you fill it with a temporary measure. You fill it with debt, and then in the next cycle, you take it away again, which means you need to replace it with debt, and it grows. The national debt of the United States is something like $100 trillion. And how did that happen? How was that allowed? Well, what it represents is the profit that the United States economic system has made. Whenever there's been more goods and services there at legitimate costs above, legitimate prices above the incomes produced, they have to create more money. So they create it as a debt. And then next year that reoccurs. They create more as a debt. So the national debt is really a compilation of the profitability of the United States that's built up there over 100 years and more. And it's totally unnecessary. If we say, look, it's possible in mathematics to have one as a +1 or a -1. We can create $1 either as a debt or as a credit. It just matter what sign you put in the front of it when you symbolize. It is an abstraction. It's an abstract that has number. So if we put a negative sign in front of it, we can actually, when we make a profit and we issue credit, which is credit and not debt, that will actually cancel out some of that debt. And we begin to bring down the costs. There are costs overhanging US prices equivalent of $100 trillion that has to be serviced in debt. And there's your answer. That can make it so much easier for everybody. It can, I'm a farmer. I know that what creates scarcity, what creates greed is scarcity. If animals are really hungry, desperately hungry, they are greedy. If there's plenty there, they're as nonchalant as whatever. They play with each other, they sniff the breeze, they go for walks. And that's what human beings are like too. And we can create that sort of a society, a caring society, a society that does look at values and can look at values, rather than one that's forever chasing, trying to catch up to a $100 trillion bill, debt bill, in the case of the United States, which is ever running away from and getting further away. It's impossible. It's impossible. We've got to rethink.
Okay, so let me ask you guys a question about what happened in 2008. And so, and I may be completely wrong about this, but my understanding was that the 2008 crisis was fundamentally produced by a technological revolution. And the technological revolution was something like the realization that you could take investments of a certain risk level, mortgages, let's say, substandard mortgages. And by bundling them together in huge tranches and huge groups, you could quantify the risk. And as a consequence of quantifying the risk, you could discount, you could make the group of investments more valuable than they would be as the sum of the individual investments.
Well, something has to be said here about our attitude to housing and the subprime crisis and all that. If you go back 100 years ago, most money was loaned in the community for production, or a great deal more than it is now, to finance inventories and capital machinery and all that. And then we got into another period where consumer goods contributed quite a bit. After the Second World War, we were building refrigerators and vacuum cleaners and a lot of those type of things. But finally, because we have to increase the debt every year or we can't keep the economy running, if we're right, there is a deficiency of purchasing power, a gap continually occurring. It got to the desperate situation where the only way you could fill it, or the elephant in the room, as it were, was housing loans. Now, in both the UK, the US, and in Australia, 2/3 of all the money that exists in those countries was originally loaned into existence to buy residential homes. And the money supply was increased by simply lending, say, $500,000 to 3 different families to bid against a house at auction. The price would be $500,000. If you want to increase the money supply further, well, you loan money $1 million to half a dozen families, and yes, it'd bring $1 million. So this was the process that was going on. And it got more and more ridiculous, and the intention to increase the money supply was overheated and ridiculous, but it had to be done to some extent. Actually, in Australia in 2007, our money supply was increased by 19%. Can you imagine? And most of that was increased in financing housing. Now, eventually, the enthusiasm for cranking the money system up higher and higher was so great that they began lending to all sorts of people, irrespective of whether they had a chance of repaying it. Some would never be employed and probably never could be employed. Others were chronically underemployed. And so eventually we got this great amalgamations of mortgages that nobody really knew who the mortgages, what homes, or who was behind, was owed that money. And the mortgagees generally didn't know who owned their mortgage. And the thing was exploited and fell down because they were over enthusiastic in keeping the debt running. But if you take away the need to increase the money supply by about 20% of consumer production every year just to keep the place out of recession, then you can cool a lot of those excesses.
These huge economic booms, we print a bunch of money, inflation runs hot, but so do assets. Everyone thinks they're doing really well. And then we have these catastrophic retracements back to economic reality.
So in that segment, Robert's explaining basically the Austrian business cycle, or the Austrian theory of the business cycle. We would explain the same phenomenon in terms of debt. So most of the money supply exists in the form of bank credit, which when it's created and issued as a debt or a debt equivalent. And that means that when the economy is doing well, there's a lot of investment, there's a lot of borrowing. It can be the case that too much money is found in consumer pockets, and you could have demand inflation, but sooner or later, the economy cannot maintain this ever increasing debt, because the more debt you take on, of course, is you get to the point where you can't service it properly. Lenders don't want to lend it because they're afraid they're not going to get it back. So eventually the debt burden becomes so great that it can't be maintained by producers, by consumers, or even by the financial brokers themselves. And when that happens, when we're not able to induce more people to take on debt to keep the momentum of the thing going, then some of the debts that have been taken on cannot be repaid. And some businesses go bankrupt, some individuals go bankrupt. The banks themselves can end up taking losses because they have to write off some of those debts as bad debts. And then we have a period of recession where we sort of get rid of the excess debt, the surplus debt. Once that happens, and people have lost businesses, jobs, what have you, then we can again begin the process of gradually increasing the flow of loans, building the economy back until eventually it overheats and the whole thing repeats itself again. So we think that debt holds a huge part of the explanation for why we have this business cycle. And if you address that along the lines that we're suggesting, you should be able to introduce a great deal of stability into what has hitherto been a rather unstable system.
It's funny because, maps of meaning could have been called maps of value. And obviously money is a map of value, but I hadn't drawn the analogy between a map of value and money. Although in retrospect, that seems like an obvious thing to do, which is why I got interested in your idea about incorruptible money.
Yeah.
And so you think of incorruptible money as computationally advantageous, essentially. That's the basis of the idea.
Yeah. And I think, again, to pursue this, I think Bitcoin is the regenerative hero in different form. It takes the forces of nature. It digs into chaos, into pure entropy, into pure energy, and let's say mathematics, and spits out the greatest form of order that we as human beings use in the social realm, which is money. And it does so in the archetypal way, in the maximal possible way of doing so. And it does so in an incorruptible manner. And so if you take if you take those things, you could easily, that could easily have been talking about the regenerative hero as described in maps of meaning. And I think it's represented in Bitcoin. It's instantiated in Bitcoin. And that's why it's having such a revelatory effect on.
Well, I think John's incorruptible money is rather spiritualized and romanticized. Honest money must reflect the truth. If the economy has $2.4 trillion worth of consumer goods that cannot be consumed with society's then incomes, then something must be done. We can't say, well, no, you can't have that because enough gold wasn't dug out of the ground in the last few weeks. Sorry, that's got to be solved. And it's solved by producing an enumerated abstraction. But that has to be done responsibly. It has to be measured. And there has to be proper legislation and institutions with court-like powers that decide what the numbers are and how they're going to produce and how they're going to be distributed. A distribution of a national dividend will allow consumption to take place now, but it will not add to national debt because we're not putting it out there as debt. We're proposing to put the other sign before the dollar sign. Now, it's interesting that, the romanticized view of Bitcoin, to me anyhow, because my acquaintances that bother with Bitcoin, they want to buy it if they think it's going to go up, and they want to sell it if they think it's going to go down. It's really a speculative medium for them. And it's sort of like the roulette table in a casino. And yes, there might be few advantages in transferring it, of a technical nature, but they don't see it as something that's going to reform the world. Where Oliver and I do see a means of reforming the world, taking away from a debt culture, put it into a culture where that reflects our industrial heritage and the interdependence, where all people contribute, all people inherit part of the productive capacity, as because our ancestors all contributed to it. So that's how we see it. But of course, there's always an element, you know, like there's an old saying that to the bootmaker, there's nothing like leather. And there's an element of that with all of us. Like, to me, there's nothing like social credit. And to the Austrian school, there's nothing like gold. And to others, there's nothing like Bitcoin. But I think we've got to get past that, and we've got to try to look at the real things and not spiritualize or romanticize them beyond what reality demands and allows.
There is no value in money without sacrifice. There has to be an energy expenditure to secure the supply of money or the network of money. That's what ensures against its corruption, basically. Mm-hmm. And if we zoom out,
it wouldn't cost anything.
That's right. And someone would just arbitrarily suck value out of it by printing it, right? That's what the central bank is designed to do.
I think the concept that money has no value without sacrifice is pretty much like that other mantra, if you like, that there's no such thing as a free feed. I've yet to find one person that's been able to explain to me how he's paid the full cost of an apple. Nobody has invented the intellectual property, which is an apple. The apple was there. They got the concept of an apple for nothing. They got the DNA of an apple for nothing. They got a few square meters of earth supported by what supports it all the way to the center of earth. Again, free. The capital cost of producing suns is very high, and it may even be beyond us, clever though we think we are. So nobody, it's impossible to pay for an apple, the full cost of an apple. So saying there's no such thing as a free feed, it's impossible to pay for a feed is the absolute truth of the thing. And to say that we don't value something because God gave it to us for nothing, but because it was just there, I think is running away with materialism. You know, some of us have an approach where we think that if we can take a slightly Spartan approach where you don't eat 16 bananas because they're there and they're free, you have one if you want one and you don't have one if you don't want it. That's the sort of approach we need here. We don't need to be sacrificing and making things difficult because it's virtuous. It's not necessarily virtuous at all. You might see it as virtue and virtuous to impose difficulty on others, but I don't think that's really a moral way to approach that. So to say that there's no value in anything that you've had for nothing is a great distortion, and we need to get it right. And we can't get ourselves right with God if we can't get ourselves right with the cost of an apple.
Yes, also with regard to this notion that there's no value in money without sacrifice, it's important to also acknowledge that if you were to institute an honest financial system, involving fiat currency plus bank credit, as we suggest, there is a cost involved in making it honest and in making it reliable. So, no one is saying that, there isn't a certain amount of effort required or resource consumption required in making the financial system reliable, but it's not what the money is that makes it reliable. It's the institutions and the regulations and the laws and the people involved that are going to determine whether it's reliable or not.
In other words, it's the culture.
Yes.
The culture has to change. We've got to, if we're going to move, and we are going to move away from a period of scarcity increasingly with technology, then we have to develop morally to be able to handle that. And we can't go on pretending that it's difficult to produce everything and we've got to sacrifice, because if that's the case, we'll just have to produce more and more and more, and burn up resources that are unnecessarily being used. If we've got to work for a living when the machines are doing it, then a man might dig a ditch, but if we can dig it with a tractor or a backhoe, we don't need to dig 1,000 ditches if we still need one ditch. So there's a sense of perspective in this, and we do need to develop morally to get our heads around what's happening in the human economy at the moment.
You make a case there. You make a case for a kind of technological inadequacy, is that as a species, we haven't been able to generate a sufficiently incorruptible language of value, and that has produced all sorts of negative consequences, some of which you're outlining.
So the important thing in making a monetary language a language of value, from our point of view, is to make it honest, and that doesn't mean therefore scarce. If you make something scarce, that means that there's not enough, right? There's a lack. There's not enough to do something or to achieve something. In the case of a financial system, if you don't have enough money because you've made it scarce, then there's not enough to accurately represent our wealth or the capacity to produce wealth. And so the money system will basically systematically underestimate both the flow of real wealth and our capacity to produce real wealth. And that's going to hamper us. That's going to serve as an artificial limitation on our activities. It's going to misdirect our activities because we're not acting on the basis of accurate information. It would be like having a thermometer that read 10 degrees Celsius when the temperature was actually 22 degrees Celsius. A thermometer, like any other tool, is only useful if it is giving us accurate information about the real world. And so the money system is only going to be useful to the extent that it gives us accurate information about the real world.
So practically speaking, guys, Bitcoin, it's not easy to spend. You can't go into a store and spend it. Like, it doesn't have that portability that you described, Robert, as a cardinal element of a necessary currency. And it isn't obvious to me that it's been rapidly moving in that direction, but that may be a mere consequence of my ignorance or my timescale. Maybe it'll happen in 10 years, and that's virtually instant from a historical perspective. I mean, do you think Bitcoin can leap the gap?
Yeah, the question of Bitcoin becoming sort of a universally accepted currency is an interesting one. You see, gold became that, but it only became that because fiat money could be created on the basis of gold, and therefore it was widely dispersed and accepted. If Bitcoin does achieve universality, will it be any different to gold in one respect? Will we only be able to get flexibility into Bitcoin? Because apparently a virtue of it, it's inflexible, you can't create it easily. The only way, therefore, that it will work is if we create enumerated abstractions, we create paper claims on gold, we we create demands for Bitcoin in cyberspace or as bits of paper to give us the flexibility to increase what we think of the amount of Bitcoin in existence. And gold didn't work except as a myth. And I suspect that Bitcoin, because it's scarce, will not work either because it's inadequate, except as a myth. And that means until we have fiat Bitcoins, it won't be flexible, it won't be able to do the job, and it will fail in time.
And I think that money, because it's the thing that allows you to determine the relative worthwhileness of everything else, it means that there is nothing more important than that object. So whatever the free market selects as the money, the resources used to instantiate that, to perpetuate it, are definitionally worthwhile because it permits the relative valuation of everything else downstream of it.
Yeah, so I do take issue with the idea that money determines the relative worthwhileness or the value of everything else. There are many things that in life, let's say, that I think many of us would regard as priceless, as being beyond price, and that you cannot in any way put an economic value on it. It transcends questions of financial dollars and cents. Beyond that, even in the realm of economics, strictly speaking, if you look at production and consumption, there's a lot of production and consumption which occurs outside of the formal economy that involves, let's say, unpaid labor. So if you think of the unpaid labor of the homemaker, there's, cooking, cleaning, all sorts of other tasks that may be undertaken. That involves production, that involves consumption. And yet, because it's not paid, it doesn't register in financial terms. It doesn't show up in the GDP figures. But it's still something of economic value, even though there's no, at least not statistically, there's no reference of it having any kind of monetary meaning or value or purpose. So I think we have to get away from this idea that money is the be all and end all. As important as it is, and as much as it conditions our activity, even in our existing economy, there are values, non-economic values, but even economic values that don't fall under this reign of money.
It's interesting that gold played the part of fiat money as a palliative myth for a long time. And I think it was more or less being a case of saying, dear, there, dearie. Oh, the bank is full of gold. And that was the price of domestic peace while the world was built.
Right, to build a system that we can't. Well, so that's that's kind of an interesting conundrum there too. You kind of ask yourself, there's no shortage of dire science fiction predictions about the buildings of systems that we can't even stop. Downsides to Bitcoin. Well, how about the facilitation of criminal activity, underground criminal activity, for example? And like if you guys put your heads together and you had to critique Bitcoin.
Well, the point is that the state has got sufficient sanctions to regulate cryptocurrency. It depends upon communication. And while that's disappeared into cyberspace, it seems that is able largely to be regulated also. The state has awesome sanctions if it wishes to choose them. The Bitcoin doesn't have a program of reforming the fiat money system. It doesn't want to reform it. It wants basically, I suppose, to displace it, and to displace it with something which is scarce, and that will create enormous difficulties. I don't doubt that when they're good and ready, government will regulate all cryptocurrencies. And that'll because a number of things like criminal activities, laundering drug money, tax avoidance, funding criminal activities of all sorts, and also just theft, bad faith in cryptocurrency exchanges. So it will be regulated. And if it's going to displace the current fiat currency, which grew up around gold, it'll have to grow up another one around Bitcoin, or it won't have the flexibility, because the facts of the matter are, we've measured the deficiency of purchasing power. We know it's there. No government has measured it. They don't do profit and loss accounts. They don't do supply and demand accounts. They don't do comprehensive balance sheets. They don't know what's going on, and apparently they don't want to know. But we know because we've measured it. And if I've measured a crocodile and I know he's 12 foot or he's 16 feet, I know there's a crocodile there and there's a deficiency there, and I know the length of the crocodile. So Bitcoin it might replace gold in people's affections and in their romanticizations, if there's such a word, but it's not going to provide a flexible money system that can hand us all access to that industrial inheritance, which is the property of us all.
Making a case, all of you, that the very act of Bitcoin sanctifying the sovereignty of the individual is actually tilting individuals towards doing something good rather than something bad.
Yeah, so we also would agree, I think, that if we had the sort of honest financial system that we have been proposing, that this would tend to encourage virtue, for lack of a better word, and discourage vice. And it would, if you will, tilt the playing field in such a way that it would facilitate constructive human behavior and disincentivize lying, theft, cheating, antisocial attitudes and activities of all sorts. The individual, of course, would remain free. We believe in that people have free will. They would be free to choose how to behave, but the system itself would, instead of being an obstacle to constructive behavior, would actually be a facilitator.
I think the fact that we're having this conversation, doing this video, that the different parties are trying to think it through, is that we do have a problem, and we know we've got a problem, and a fairly large one. And there are big changes coming into society where employment will be progressively displaced by automation. The car manufacturing company Tesla believes that the work they're doing on driverless cars will provide so much technology that a great deal of the repetitive jobs, in fact, nearly all of them, will simply disappear out of the economy. So if we haven't got widespread employment as a distributive mechanism, what do we do? Now, they can all go and get in their computers and burn up electricity and try to create Bitcoin, but it doesn't seem terribly sensible to me when the thing is so easily created. The thing is, we've got to stop it being dishonestly created. And that means the people that make the decisions about how much will be created, which we suggest a national credit authority with defined powers and court-like powers, that makes the decision on how much fiat money is going to be created.